Hello and welcome to the Business Standard Morning Show. I'm Kanishka Gupta and let's have a look at the stories for the day. RBI Governor Shaktikanta Das last week said the central bank was assuming the Indian crude basket's price to be $100 per barrel in the second half of FY23, which is down from around $104 per barrel in the first half. Now, this estimate underpins the central bank's growth and inflation projections, which is why the recent decision by the OPEC Plus to impose larger than expected output cuts in a bid to spur a recovery in crude prices could become a cause for concern. Against that backdrop, today's segment will delve into the possible impact on India.
The Reserve Bank of India has retained its FY23 inflation projection at 6.7%, with Q2 at 7.1%, Q3 at 6.5% and Q4 at 5.8% based on its assumption that the Indian crude basket's price would be lower than before at $100 per barrel in the second half of FY23, and retail inflation is projected to reduce to 5% in the first quarter of FY24. The RBI has also revised its FY23 growth forecast only marginally to 7% from 7.2%. But the Organization of Petroleum Exporting Countries and its allies, collectively known as OPEC Plus, pulled a shocker this Wednesday. They have decided on cutting oil production by 2 million barrels per day, a move that will again push up crude oil prices. Despite pressure from the US to pump more crude to help the global economy, the new production cap levels will come into force from November this year and remain in place until December 2023. From their recent low of $82 a barrel around the 26th of September, Brent oil prices have climbed over 13% to more than $93 a barrel at present. Some analysts believe that Brent is likely to top the $100 per barrel mark. We spoke to Paul Hicken, a commodities expert, to understand what kind of floor has been set by the OPEC Plus move for oil prices for the next few quarters.
The producer group is seeking to send an unambiguous message to the market about a willingness to reduce supply to support rising price objectives. Clearly, there's a sign to say $90 a barrel is the psychological price floor. It's a floor that potentially OPEC Plus will look to defend. While there's a lot of volatility, it certainly seems for now that $90 a barrel is something that at least the producers are looking at as a sign of stability.
From its high of $116.01 per barrel in June, the monthly average price of the Indian basket of crude oil fell to its lowest level in FY23 at $90.29 per barrel in October. An impact on these prices is possible since the Indian basket of crude oil represents a derived basket comprising the sour grade, which is the Oman and Dubai average, and the sweet grade, which is Brent dated, in the ratio of 75.62 is to 24.38. According to a UBS report, the price of Brent could shoot up to $110 per barrel by the end of December 2022 and hold at $125 per barrel in 2023, all the way till the end of September. If these projections hold true, the consequences would be dire for India due to higher inflation, lower consumption, and a worsening of the external sector situation. Ultimately, the country's growth rate would be compromised. The retail inflation rate reversed its 3-month downward trend in August, rising to 7% from 6.7% in the previous month. While not everyone agrees that the price of oil will shoot up to the extent projected by UBS, with increasing crude prices possibly raising inflation, how concerned should India be on the growth front?
In the latest policy, the RBI has spoken of crude oil price averaging $100 per barrel for the second half, which would broadly be in line with what could be the possible impact on account of this particular cut which has been invoked by OPEC. So right now, if they move it up to say something in the region of $95 or $100 per barrel, to my mind, I don't think that would upset any of the official inflation calculations. See, we were toying with a price right up to $120 per barrel when the Ukrainian crisis erupted. After that, we have seen the price being in the range of around $100 to $110 per barrel. And our growth remained more or less resilient to whatever was happening externally and whatever was happening through crude oil price. So today, I would say that anything up to the level of, say, $95 to $100 per barrel is something which could be tolerated by the economy. And there could be a case of saying that overall growth may not be impacted much. And we could still be looking at growth in the region of around 7% for this financial year.
India imports over 86% of its oil requirement. A rise in prices will mean that India's import bill will also increase. As a result, the current account deficit, or CAD, will widen. India's April-June CAD came in at $23.9 billion, or 2.8% of GDP. This represented a 15-quarter high. There were apprehensions in some quarters that the CAD could widen all the way to 5.5% of GDP in the second quarter, which would be the second worst quarterly deficit on record. One agency had estimated that CAD could widen to a decade high of 3.8% of GDP in FY23. In FY22, the CAD was 1.2% of GDP. So, what will be the impact of the OPEC Plus move on India's increasingly vulnerable external sector?
We are talking of this deficit, current account deficit being in the region of around 3.5% of GDP. I think it was premised on the fact that global commodity prices have also eased and have come down, and the CAD is going to be affected more because of the global recession. But today we're talking of a situation where moving from 90 to even 95 or 100 would definitely mean that our trade balance would get widened, which in turn would put pressure on our current account deficit and finally the balance of payments. So the external sector is something which would definitely be vulnerable to any kind of an increase in crude oil price.
The overall situation remains dynamic. In September, Russia bounced back to become India's second largest crude supplier. However, pressure from the US continues on this front due to the war in Ukraine. The Wall Street Journal recently reported that the US could conditionally ease sanctions on Venezuela, allowing Chevron Corp to pump oil in the country. Meanwhile, the US has accused OPEC Plus of aligning with Russia after the group agreed to the deep production cuts. The US has also said that it will continue to release oil from its strategic stockpiles. The anti-cartel legislation, known as NOPEC, which had been considered by the US in the past, was also brought up when reports said that President Joe Biden would work with the US Congress on legislation to curb OPEC's control over energy prices. For their part, the challenges for the Indian government and the RBI will depend on exactly where crude prices land. At the very least, they will have one more major challenge to contend with on the external sector front.
After the oil, let us shift our focus to the pharmaceutical industry. The World Health Organization has issued a global alert over 4 cough syrups made by an Indian pharma company, saying that they could be linked to the death of 66 children in the Gambia. Now, it has also triggered a probe from the Indian government. So in today's segment, we ask who all are responsible for the quality checks of Indian pharma exports.
The World Health Organization on Wednesday said that the deaths of 66 children in the West African country of the Gambia may be linked to contaminated cough and cold syrups made in India by Delhi-based Maiden Pharmaceuticals. In a medical product alert covering 4 India-made pediatric syrups, WHO said lab analysis had confirmed unacceptable amounts of diethylene glycol and ethylene glycol as contaminants in them, which can be toxic and lead to acute kidney injury. WHO says that all batches of these products should be considered unsafe until they can be analyzed by the relevant national regulatory authorities. The products may have been distributed elsewhere through informal markets, but had so far been identified only in the Gambia, the WHO said in the alert advising regulators to remove these syrups from the market. The 32-year-old Maiden Pharmaceuticals, which has 2 manufacturing plants in Haryana, said it is not selling any product in India currently. Reports indicate that India is awaiting more information from the WHO, as the UN Health Agency is yet to provide the exact one-to-one causal relation of the deaths. WHO said that information received from India's Central Drug Standard Control Organization indicated that the manufacturer had only supplied the contaminated medications to the Gambia. The WHO's medical product alerts are designed to warn member states and public of the existence of dangerous medical products and encourage increased vigilance and appropriate regulatory action. It has issued 5 such alerts so far in 2022, 11 in 2021, 7 in 2020, and 11 in 2019. Most of the alerts pertain to falsified medical products that deliberately or fraudulently misrepresent their identity, composition, or source. The latest alert is the first instance since at least 2019 that a warning has been issued for contaminated medicines made by the genuine manufacturer. The deaths of 66 children in the Gambia is a blow to India's image as a pharmacy of the world. India is the 3rd largest producer of medicines by volume and the biggest supplier of generic drugs. India supplies over 50% of Africa's requirement for generics, around 40% of generic demand in the US, and 25% of all medicine in the UK. In FY22, Indian drug and pharmaceutical exports stood at $24.6 billion, growing from $22.4 billion in the previous year. So who is responsible for quality assurance of pharma exports from India? Darren Punan, a pharmaceutical law expert, tells more.
When it comes to drugs that are being sold in India, both manufacturing standards and product standards are something that the Central Drug Standard Control Organization, along with state drug controllers, are responsible for. And they look into whether companies are compliant with both good manufacturing practices as per Indian law, as well as product standards as per Indian law. But when it comes to products that are meant for export only, the product standard itself is not necessarily something that is regulated from an Indian law standpoint. The activity of manufacturing is regulated in India. Then they will make sure that the manufacturing standards are up to the mark. And to that extent, there is a requirement under good manufacturing practices to ensure quality control, or that you have a quality control department that ensures quality control. And if another country requires anything beyond what Indian requirements, for example, the US FDA does specific inspections of Indian facilities when that product is meant to be supplied for the US. And in the same way, the WHO, they also have a particular GMP standard, which other countries may rely on. Now, in GMP, the main things that are looked at are the plant and machinery, the staff that's being employed, the competency, the qualification, and to ensure that, for example, if there is a sterile activity taking place, how the sterility is maintained. If there is purified water being used as part of the manufacturing process, how are you procuring it? How are you storing it? How are you supplying it? And the product standards are going to be governed by a pharmacopoeia standard.
The pharmaceutical industry in India is currently valued at $50 billion. The domestic pharma industry includes a network of 3,000 drug companies and approximately 10,500 manufacturing units. It also has the highest number of US Food and Drug Administration or FDA compliant pharma factories outside of US. Consequently, several poor manufacturing practices of the industry came to the forefront, which initially affected many firms adversely, but over time led to the adoption of better measures which helped the sector to penetrate many markets and achieve global credibility. To understand if there are any systemic issues plaguing the pharma manufacturing sector that could lead to production of substandard products, we spoke to the former commissioner of the Maharashtra Food and Drug Administration.
The diethylene glycol, or DEC, that is found in the syrups, this is not new. It's started from, I think, 82 onwards. Many such instances have happened. Few years ago, such instances were recorded in Jammu and Kashmir. Some children were affected. Under the Indian statute, the rules say that any raw material taken for the production of any drug has to be tested for its purity, and the record is to be maintained. Every batch that is manufactured, and before releasing it in the market, they have to also test the drug for its purity, that it doesn't contain any element or the chemical that is harmful. But whether these provisions are complied with or not, that's a big issue. When I was Commissioner FDA Maharashtra, I found that this particular practice of testing buy the unit before the production and before the releasing in the market, the entire batch results. They are not checked by the regulatory authorities like the DCGIs, field offices, or the drug controllers of the state. And there is no mechanism of supervision by the central government also. They don't do it. These units are to be inspected by the drug inspectors very frequently. And one copy of such a report of the inspection by the drug inspector has to be sent to the drug controller, and he has to monitor it. Unfortunately, in this country, one copy going to the drug controller, it doesn't happen. Drug controller doesn't check whether this is happening or not. So it is the gross failure of the entire regulatory mechanism.
Only after the investigation into the Gambia incident is concluded will we know where the responsibility lies. If the lapses are found on part of the manufacturing plant in India, then both the state and central drug regulators could be held responsible. In the meantime, the damage to the Indian pharma industry's reputation may already have been done.
Moving on to markets, retailers ended the 9-day Navratri festival season with a bang. Sales of consumer goods were the highest in 2 and 3 years this time, and consumers indulged in out-of-home purchases despite price hikes. The surprisingly steady sales despite inflation have turned analysts bullish on the sector as they see festive season adding more sheen to the related stocks. Our next report takes a deep dive into the sector's prospects and lists stocks that are on analyst radar.
India's consumption sector is playing on the front foot this festive season as consumers rush to markets and restaurants after 2 dull years marred by the pandemic. Despite price hikes, inflation, and muted rural demand, aggregate sales volume for consumer goods remained steady during the July-September quarter. Analysts see the trend sustaining as discretionary demand remains strong in the middle and upper middle class of population. According to Amnish Agarwal of Prabhudas Leeladhar, huge pent-up demand continued to fire growth in most discretionary segments in Q2 FY23. Staples consumption in rural India remained more impacted than overall urban consumption due to inflation. Going ahead, rural demand is expected to bounce back in second half of FY23 on low base and favorable monsoon. His assessment may be playing out on the ground at the moment. The recently concluded 9-day Navratri festival saw retailers clock their highest footfalls in 2 to 3 years across segments such as automobiles, consumer appliances, and apparels. And since price hikes taken by companies in Q1 have been absorbed well by customers, analysts expect this consumption trend to remain strong given festive period and year-end celebrations in Q3 FY23.
Over the last 3 months, FMCG index has outperformed the Nifty index, largely led by improving financial performance and ahead of the peak quarter based on the festive period. We believe that any signs of a sustainable recovery in rural FMCG growth could be the next big trigger. However, delay in rural demand recovery, sticky input prices, and higher competitive intensity from current and new players pose risks to this expectation.
Jasani expects FMCG companies to witness significant gross margin expansion between FY22 and FY24, assuming normalization of input costs and partial reversal of price hikes.
Over FY22 to 24, assuming normalization of input costs and partial reversal of price hikes, we expect material gross margin expansion, bringing it closer to FY20 levels. Operating cost savings witnessed over FY20 to 22 could reverse going forward largely due to higher marketing spends, thus restricting operating margin expansion. But the overall cost structure will still remain below FY20 levels due to aggressive cost efficiency initiatives taken over FY20 to 22 leading to a better EBITDA margin profile. On the valuation front, earnings multiples of large FMCG companies are in the range of 50 to 65 times 1 year forward EPS range. Given the entry of large conglomerates like Reliance and Adani into the FMCG market and their aggressive ambitions, we expect valuation multiples to remain stable.
From an investment viewpoint, Nishit Master of Axis Securities PMS likes EIH, Aditya Birla Fashion and Retail, Maruti Suzuki, M&M, Tata Motors, Westlife Development, Jubilant Food, Trent and Bata. As regards today, global cues, oil prices and stock-specific action will guide the investor sentiment.
In a bid to cut down on environmental waste and save consumers from buying different chargers for different devices, the European Parliament on Tuesday voted in favor of legislation to standardize the charging port on electronic items. It selected USB Type-C, better known as USB-C, as the standard port. But why did it choose USB-C as the standard port? What makes it the gold standard of charging ports? Our next segment tries to answer.
The European Parliament on Tuesday voted to standardize the charging port on electronic items. Once this becomes the law, all mobile phones, tablets and cameras sold in the EU must have a USB-C port by the end of 2024. Laptops are also part of the list, but the deadline for manufacturers is set for spring 2026. The European Parliament has said that regardless of their manufacturer, all new mobile phones, tablets, digital cameras, headphones and headsets, handheld video game consoles, and portable speakers, e-readers, keyboards, mice, portable navigation systems, earbuds, and laptops that are rechargeable via a wired cable operating with a power delivery of up to 100 watts will have to be equipped with a USB Type-C port. USB-C is not new. Its specifications were first published in 2014. Yet its adoption has picked pace only in recent years. Unlike its previous iterations, the USB-C has a small oval port with no fixed up or down orientations. Its symmetrical connector makes it easy to plug in. Besides the ease of use, what really makes USB-C the gold standard of charging ports is its ability to support fast charging and super-fast data transfers using a single cable. Not just data and power, USB-C also supports sending simultaneous video signals of up to 8K resolution. So does your phone's existing USB-C port support all this? It depends. You may already have a USB-C port on your device but still cannot use all features and functions such as host device charging and video out. It is because different manufacturers use USB-C for different utilities. To get around this challenge, the EU has made it mandatory for the manufacturers of electronic items to put a dedicated label to inform consumers about the charging characteristics of new devices. So how will it affect different manufacturers of electronic devices around the world? USB-C was developed by the USB Implementers Forum, a group of companies that has in its membership big technology brands such as Microsoft, Apple, Samsung, HP and Dell. While most tech companies have moved to USB-C, Apple is still to make a move as far as its iPhone and AirPods lines are concerned. It now has a 2-year window in which it needs to move its devices to USB-C. According to Apple analysts, the company might launch an iPhone with a USB-C port in September 2023. The European Parliament said that disposed of and unused chargers account for about 11,000 tons of e-waste annually in the EU. Imagine the worldwide figure and how this new law, if implemented across the globe, will help in reducing e-waste. And when can India move to a world with just one kind of charging port? India too has considered the idea of a single charger for all electronic devices. The Union Ministry of Consumer Affairs has written to industry players to devise a plan for having one cable for charging all your devices. If manufacturers move to a world with only USB-C ports because of changes in European laws, then India will also not be unaffected. you may finally get over the hassle of finding different chargers for your devices.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
EU competition chief Margareta Vestager has said that the rule may save at least €200 million per year. Now that is all for today. For more news, views and analysis, please log on to business-standard.com. If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.